Well, hello, I'm Chris McAlpin with Sound Financial and the host of the Chase podcast. I hope that you're subscribing to us. I hope that you look us up wherever you podcast. I hope that you are ringing the bell at the bottom of your screen. I hope that you're writing a comment, sending us an email, talk to us, give us feedback of how these client updates are going. Because in these client updates, this being our May client update, we're talking to our friends, our family, to our clients, those that have trusted us to help you walk through your financial life. And we don't take that trust lightly. We want to give you good education to empower you to make great decisions so that we can work together to get you to your financial goals. And there's a lot of things going on in the world this year, and I've talked about them in the previous months. And I think some of these topics I'm going to continue to talk about for the rest of the year. But this particular episode, this particular update, I want to talk to you at home as if we're sitting at one of our dinner seminars. And I'm going to go through part of the presentation that I've used even so that we can look at what's going on in the world. We can discuss it, kind of pull it all apart and just see if we can make sense of it and how it affects your financial life. Because at the end of the day, we want you to succeed at your financial goals. That is our job. That's how we serve you. And so we want you to be successful. Just rock and roll through life and live well. Okay. So let's look at some of the things that are taking place. And just a situational analysis, right? We've talked about this since January, but we have inflation filling up our economy. And it is causing the Federal Reserve to raise interest rates to try to slow that inflation down. But let's take each of these parts and talk about them in a little bit of a common sense way. Go back to 2020. We have the COVID pandemic, and our government flooded the economy with over $5 trillion in cash, right? Whether it went to the businesses or whether it went to the individual, it pushed that much money. And it also actually went into the bond markets themselves, pushing that much money into our economy. And the way that the economy works, you have supply and you have demand. And when they equal each other, it's called equilibrium. They're always going to balance each other out. When you push that much cash into the economy, it is going to fuel demand. Okay. So our demand of hamburgers and gasoline and gallons of milk and widgets that we have fun with, that rose starting in 2020, and supply could not keep up. So therefore, prices rise. That is inflation. So the way that the Federal Reserve reins that in is they start to take money out of the economy. They take money out of the economy by raising interest rates, okay? And they'll slowly take money out of the economy. Now, when it comes to inflation, the Fed has another challenge, is you've had supply chain disruptions all over the world that brings supply down as demand is going up. And so those rising interest rates will only do so much to rein in inflation, okay? While they're raising those interest rates over here in the bond market, that pushes bond prices down. And in many of our retirees' portfolios, we go to bonds to be conservative. This is why in the April update, Clint and I talked so much about the bond market. We want you to be patient. We'll take a little tangent over here on the bond market. I want you to be patient, keeping in mind that how bonds work, that if you own a bond, the par value is going to be returned to you, and all the while you get a dividend paid to you. But the really painful part of what's going on in the bond market right now, and it has been for 9 months, it's been pricing in the rising of the Federal Reserve's interest rates. Okay, so we got a couple of moving parts. Demand that got fueled by all the cash during COVID, supply that got pulled back by all the shutdowns during COVID. Okay, now that's causing inflation, causing prices to go up. Stay with me. And the Federal Reserve is going to pull money out of the economy by raising interest rates, which is causing problems in the bond market, but we believe that that would be over soon. Okay, now there's one other piece that's happening. Russia attacked Ukraine. And this took place right in the breadbasket of the world. And this is going to make supply chains even more exacerbated. Okay. Because in this area of the world, 25 to 30% of the of the world's grains, cereals, and a lot of cooking goods like sunflower oil, things of that nature, are produced right where the fighting is taking place. So there's no planting that's taking place right now. There'll be less harvesting happening in the fall if there's no planting today or less planting today. Okay. So we're going to have grocery type items that the prices are going to stay high. We also have oil. We have oil and natural gas sanctions on Russia. So that's taking some of that supply out of the economy all over the world. Add to this, something I don't have on the screen is that in Southeast Asia, especially in China, they're shutting cities down because of their zero COVID policy. That's going to put more pressure on the supply chain. So we're getting supply and demand are getting further apart, and the only way for them to find equilibrium is price. Okay, this is just the way the world is today. This is just the this is just a year we're going to have to go through. These happen sometime. It's not Armageddon. I haven't seen the sky roll up like a scroll. I haven't seen King Jesus return. If he does, hey, I'm going to praise God and we're going to be done with this conversation, all right? But that just hadn't happened yet. So we've got to walk through this year wisely, and we want to control what we can control. That's how we should respond. And so here's some of our investment principles, because I want you to think of the investment principles of how they help you reach your goals. That's what's most important. Number one, we want to avoid large losses. Large losses, that doesn't mean avoid zero losses. Okay. Don't panic when you see your account down 5, 6, 7, 8, 10%. It's not time to panic. I'm going to show you a chart in just a minute of how that works out. But we need some room on the downside to earn returns on the upside. You really need to stay invested in your model. We just need to make sure that that model fits you. But number two, we want to let our winners run. Now, this does not necessarily fit for today, but this is a part of our investment principles that when we have a good investment, we want to let it run. We don't want to sell it for a profit to just pat ourselves on the back. Let that winner run. Number three, very important for today, we want to manage our emotions. This is hard watching 24-hour news channels, okay? Because the world's just going to hell in a handbasket. I mean, it's just wrecking. It's hard to manage our emotions, but we want to control what we control. We want to have plans that we have mapped out with you. We have investment strategies that we've mapped out and we've tested over decades of data. We don't want to make a knee-jerk gut reaction and change away from those plans just because we get scared. All right. I say it a lot of times, but God has not given us a spirit of fear, but of love, power, and discipline, self-discipline. Number four, test everything. We take our investment models and we test them and we test them and we test them and we test them. I never look at a headline and say, we need to do that. Walk in here and we do it. It just doesn't work that way. It is a bad idea to look at a headline, look at politics, look at some one article and just shape your opinion around that. And it's done a lot. We're not going to do that here at Sound. We're going to test any idea that we have and see if it works first. Number five, fit the risk. What I mean by that is I want you to, we take your financial plans and goals and dreams, and this is what you accomplish those. This is the type of investment return that you need to accomplish those plans. This is the type of risk that you're willing to accept to achieve the return, to achieve those goals. That's fitting the risk. And I want you to feel what that portfolio is going to act like and see if it meets your eye. Does it fit your personality? Does it fit your behavior? And so walk through a scenario with me here, okay? Now, in this particular scenario, this hypothetical, it is one of the traditional models in retirement. This is a hypothetical, would give you a 10.5% return a year. Now here, just on a blank screen, I want to ask, would that help you achieve your goals? I bet the answer is yes. I think most people would go, yes, Chris, give me some of that. Actually, give me all of that. I'd like 10.5% a year. Now, keep in mind, now, this is the boring but true disclaimer. These are indexes I'm talking about. They're past data, and they do not guarantee future results. And those are true statements, okay? But let's just say that because past data is the best we've got, okay? But that past data matters. Is it over a long enough period of time? Is this something we can sink our teeth into? Well, let's check. This particular past data is the S&P 500 and the Barclays bond aggregate, 60% in the S&P, 40% in the ag, going back to 1980. So 41 years of returns that we can sink our teeth into. Were there wars over those 41 years? Yeah, I remember some big ones. Was there inflation over those 41 years? Yeah, kind of some nasty inflation. Was there low interest rates, high interest rates? Yeah, there was. I remember a great recession. I remember a tech wreck. I remember a global pandemic in those 41 years. So this is some data we can sink our teeth into. So how do we fit the risk? So to get that 10.5% hypothetical, right, annual return, are you willing to accept a rolling 12-month return? And that means any given 12 months, May 15th to May 15th, July 18th to July 18th, November 11th to November 11th, any rolling 12 months, 95% of the time, you're going to get somewhere between a negative 9% return and a positive 29% return. Now, I know everybody likes that positive 29, but would you accept that negative 9 over that rolling 12-month period of time? And I think most people would. We know that we're taking some risk when we invest in stocks and bonds. Now, if you want zero risk and all the return in the market, that doesn't exist. It just flat doesn't. Get that out of your mind. We know there's no free lunch in the world. Now, if you're just so risk averse that you need to talk about zero risk and zero loss, we can have that conversation. We have investments and insurance products that fit that, but they're not what I'm talking about today. It's not stocks and bonds, okay? It's a different conversation. This is 60% stocks, 40% bonds, negative 9 to positive 29 with a 10.5% average over 41 years. I bet most people will accept that. Now, this is the kicker on this one. And this is actually where I'm not certain that it fits everybody, that the max drawdown, the max loss from peak to trough in this particular investment would have been a 32.5% loss. Now, keep in mind, this is what's great to see is even in a 32.5% loss, this particular portfolio would have averaged 10.5 a year over 41 years. And it gets even cool that of those 41 years, only 7 of them were negative. That's pretty strong. And that encourages me to encourage you that we need to get you in a portfolio that meets your eye and gets you to your investment goals, and you stay invested in it. Because every big scare in the market, all of them have this feeling like this time is different. And like this time's going to be an apocalyptic event. Every big event of my career going back into the 90s had this behavior of, I'm going to get wrecked this time. And that is completely human nature. We fear losses 2 times more than we enjoy gains. So it is in our human nature to fear loss. And then our fight or flight survival instincts start kicking in, and we treat our money with that same harsh emotion, and we can't do that because we get bad results when we do that. So this is my encouragement for you. Sit down with your sound financial advisor, have a phone call with your sound financial advisor, and look at the returns that you need to be successful and fit the risk of your portfolio. Because we have statistics like this on all of our models. We can have this conversation on all of our models. We can never guarantee the future. And I get this question all the time right now, Chris, if your investment team's thinking that we're going to have a recession in the next 12 to 15 months, why don't you rebalance our portfolio? Well, number one, we are going to rebalance the portfolios based on our rules because we cannot predict the future. That's the almighty space. It's not mine. I've tried, I failed every time I've tried to predict the future. And the few times that I might have gotten right, I was purely lucky and ended up being wrong anyway. So we're going to take solid investment principles, apply them to your portfolios. And I want those portfolios to help you reach your goals, not be the scoreboard of your life. I don't want you worried about this. I don't want you watching markets every day. I don't want you watching the markets every week. I don't want you looking at your account that much. You know what? One of us has to do that. That's me, not you. There's no reason for both of us to drive ourselves crazy doing it, okay? But we're here for you. We appreciate the trust that you put in us. You have so many resources and opportunities. I believe you can be a great success. And that is our job to help you do that. So I look forward to seeing you very soon. Take care. God bless.
For disclosure and citation information, please go to www.soundfsg.com/disclosures.